In this video, I'll explain exactly what is meant by alternative investments so you could determine if they are something that you should be investing in. And we're starting right now. Hey guys, Elliot here. So we've all heard of stocks, bonds, mutual funds, and all the other types of equity and debt investment options. It's all pretty conventional stuff and what most people think of when it comes to investing. In the last decade or so, cryptocurrencies have joined the family, and there's an argument to be made that investing in crypto is so common that it could be classified as regular investing. But I don't feel we're quite there yet, and I still refer to it as an alternative one as well. However, I discuss crypto in many other videos, so here we're just going to focus on the classic alternative investments. And those can be subdivided into 4 categories: hedge funds, private equity, venture capital, and a miscellaneous category that includes a mix of antiques, art, collectibles, wine, rare coins, and other such items. Now this miscellaneous category probably sounds pretty familiar, but if you're not sure what hedge funds, private equity, and venture capital is, stick around, and in the next 15 minutes or so you'll get a solid introduction to all of them. So let's get into it, and as always, if you enjoyed this video, please do subscribe to this channel, helps me out a lot, and don't forget to smash that like button. So as I mentioned earlier, alternative investments are investments that don't fall neatly into prepackaged categories such as stocks, bonds, or cash. Why invest in these, you ask? Well, for 2 reasons. First are the significant returns that these types of investments can bring, and second is the diversification it can offer to a portfolio. Alternative investments can be described as non-correlated assets, which just means that their performance doesn't follow the traditional investments that I mentioned earlier. So for example, if stocks go down, alternative investments often go up, and vice versa. So it's good to have at least some investments in your portfolio that don't follow the rest. No surprise then, diversification and inflation hedging are 2 reasons that investors consider alternative investments, but let's not fool ourselves. Profits and outsized returns are the main motivator. Now it's not all roses, of course, and there are some downsides to alternative investments. For one thing, they are sometimes subject to a less clear legal structure. Some of these investments have no requirements to register with the SEC and receive little to no oversight. This in turn makes them more prone to scams and fraud than regular conventional investments. Many alternative investments are also not exactly liquid, which just means that they can be difficult to sell and will take some time and effort to turn back into cash. And finally, alternative investments may sometimes be difficult to evaluate properly in comparison to stocks and bonds. For this reason, direct investment in some of the better known alternative investments is limited to what are called accredited investors. Now, if you haven't heard of the term, I have a 60-second YouTube short video on that exact topic, and it's definitely worth checking it out, and the link is in the description below. Now, direct investment is not the only way to get into alternative investments, and as I describe in more detail, I'll mention ways you can invest with specialized funds, and with those you don't need to be accredited. Okay, so those were some of the types of alternative investments and some of their pros and cons. With all this in mind, let's take a look at the list of alternative investments. Now, keep in mind, this isn't all of them. There are many other types, but these are the better known ones. And the first alternative investment we will start with is hedge funds. Hedge funds are arguably the poster children of alternative investments and are quite legendary financial instruments. A hedge fund is a collection of money pooled from accredited investors. The fund is usually privately set up by a hedge fund manager and organized as a limited partnership or LLC. Once set up and funded, the hedge fund can invest in publicly traded assets such as stocks, bonds, currencies, commodities, and derivatives. It can also invest in just about anything else as guided by its investment strategy and style. Hedge funds can also use leverage, which is borrowing money and selling short. The hedge in hedge funds actually came from the fact that it can short stocks to hedge its position against the down market. Leveraging, of course, is a double-edged sword. If used with skill and good timing, it can dramatically amplify gains, and if not done right or the manager hits a streak of bad luck, it can also lead to dramatic losses. So in summary, a hedge fund is the unshackled, unimpeded, and the somewhat unhinged wild cousin of the traditional mutual fund. Hedge fund managers can do almost anything they want as long as they deliver results by beating the market and making huge profits for their elite accredited investors. This approach proved very attractive to the best and brightest on Wall Street, and quite a few legendary fund managers became legendary while in charge of hedge funds. Hedge funds have also had a bit of a checkered history. The constant hunt for better returns led to a couple of spectacular implosions of hedge funds in the early 2000s, with a few hedge fund managers even convicted of securities fraud. Despite the controversies and a few failures, the hedge fund industry has stabilized and grown since then. Today, over 8,800 hedge funds operate on the promise of superior returns, and collectively they hold over $3 trillion under management. If you are an accredited investor and considering investing in hedge funds, the first thing you would check is the fund's annualized rate of return, followed by the fund's size, overall track record, the minimum investment required, and redemption terms in case you wish to cash out. The world's biggest hedge funds to check out include Bridgewater Associates, Renaissance Technologies, AQR Capital Management, Two Sigma Investments, Millennium Management, Man Group, BlackRock, and Citadel. Now, what if you're not accredited? Can you get in on hedge funds any other way? It turns out you can by investing in something called funds of funds, or FOFs. These are funds that invest in other, usually difficult to access funds, and you would specifically be investing in what's called fund of hedge funds. One example of this type of fund of funds is an exchange traded fund, or an ETF, and it's called the Global X Guru ETF, symbol GURU. Okay, let's move on from hedge funds to private equity. This is another major class of alternative investments and is essentially private money for purposes of investment. More specifically, private equity, or just PE, is a pooled investment fund operated by a private equity investment management company, and the fund's investment goals are to buy and restructure distressed companies that are not publicly available. As commonly done in practice, these companies that private equity goes after start out as public but are then acquired via a leveraged buyout and privatized. They are then restructured to increase efficiency, cash flow, and operating profit, and then finally offered for sale to a larger company, or sometimes led into an initial public offering or IPO. Since the companies that private equity acquires are distressed, they can use a wide variety of ways to turn things around. Some of the strategies include layoffs, replacing entire management teams, spinning off unprofitable divisions, and many others. Now, you would think that distressed companies being bought out may not want this kind of circling vulture type of attention from private equity firms, but the organization being acquired does gain quite a few advantages. Private equity can bring in an infusion of cash, expertise, or business connections, and this can jumpstart a floundering business. PE firms have a vested interest in seeing their target acquisitions succeed, and while some of the decisions they may make may be tough in the short term, the end result is increased value and survival of the acquired business. Private equity firms make money by management fees during the buyout and restructuring phase, and then if everything goes well, make a much bigger profit during the sale of the acquired and restructured company. So that was a quick crash course in the fundamentals of private equity, but let's get back to the investing side of things. As a potential investor, it's also somewhat difficult to get into private equity. Much like with hedge funds, there are high minimums to invest, and the money is tied up for an especially long time to allow for the restructuring of the company and eventual sale. How much and how long? Minimums for investing may range from $250,000 all the way to $25 million, with a typical holding time averaging 10 years. However, it is possible to sidestep all this by investing in PE exchange-traded funds, or ETFs, and some examples of those include Invesco Global Listed Private Equity ETF, symbol PSP, or ProShares Global Listed Private Equity, symbol PEX, just to name a few. These ETFs track an index of publicly traded companies that invest in private equity. They're easy to own because you can buy shares on the stock exchange with no minimum investment requirements. Another way in is to buy shares of the few private equity companies out there that are publicly traded. And two good examples are KKR, symbol KKR, and Blackstone Group, symbol BX. Finally, a third possibility is to invest in funds of funds, an approach I talked about earlier that invests in private equity. So what are the biggest private equity companies in the world today? The big four are generally considered to be the Carlyle Group, Kohlberg Kravis Roberts, better known as KKR, the Blackstone Group, and Apollo Global Management. Okay, that's enough of private equity. Let's move on to the third major category of alternative investments, and this is venture capital. Venture capital, or just VC, is somewhat similar to private equity, but with a focus on cultivating startup companies, not turning around existing ones. Venture capital is classified as alternative due to the large investment needed, the high risk of failure, and the potentially high rewards. Now, you can actually invest venture capital completely on your own. If, for example, you know some recent computer science grads and they all got together and are working on a very promising new app, you could just draw up an agreement and invest money in their startup. In exchange, you'll get a piece of the profits if they ever materialize. And in fact, what this is a very basic form of what's called angel investing. However, to do this on a larger scale, you're going to need another approach, and some legislation in the last decade opened up some new avenues. In 2012, the Job Act improved accessibility to venture capital. Among other provisions, it allowed companies to use crowdfunding to issue securities, something that was not previously permitted. The SEC released final rules on this in 2015, and equity crowdfunding went into effect in 2016. So what does this actually mean for you in terms of venture capital investing opportunities? Well, if you're an accredited investor, you now have a new approach, and that is to work with online pre-IPO startup marketplaces like Forge, EquityZen, iSelect, and Funders Club. These companies bring together startup firms and accredited venture capital investors. All of these platforms require a minimum to invest, which varies quite a bit. But if you have a chunk of cash to work with, you can become a large-scale angel investor using these marketplaces. Another approach is to invest with venture capital funds. These funds manage the money of accredited investors who are looking to spread the risk of private equity and invest in startup and small to medium enterprises with strong growth potential. VC funds, unlike mutual funds or even hedge funds, take a more active role in their investments by providing guidance and often holding a board seat with the startup. VC funds tend to be pretty big, with assets from a few hundred million to 30 billion or more, and they invest in a portfolio of companies assuming that some will fail and not deliver any kind of return, and all the capital will be lost, while some will return at least the invested capital, and only a minority of investments will return a lot more. Just like with private equity, VC funds get compensated with management fees, with the big payday, of course, when the company is either sold or has a successful IPO. Some of the world's biggest venture capital funds include General Atlantic, Hillhouse Capital Group, Insight Venture Partners, Iconic Capital, and New Enterprise Associates, among many others. Okay, in the fourth and final section, we'll cover a number of miscellaneous alternative investments and specifically focus on 5 items. These 5 items are antiques, art, collectibles, rare coins, and wine. They're all grouped together for convenience, as all 5 have somewhat similar pros and cons. In general, all are risky and difficult alternative investments to specialize in, but can appreciate and give significant returns in some cases. From a financial standpoint, the biggest disadvantage to all of these, from antiques to wine, is that none of these investments give off any cash flow or dividends. The only way to make money off of them is a sale if and when the value appreciates. A secondary disadvantage is that most of these assets require upkeep that can be potentially costly. While rare coins can just sit in a safe, antiques, art, and various other collectibles may require restoration and periodic maintenance and protective procedures. And in cases of wine collections, they also need a climate-controlled storage area. All of these investments may also require insurance, and as a rule, it's almost guaranteed that you're going to lose money long before before you make any money. You also face issues of valuation and appreciation. When you are evaluating stocks and bonds, an overwhelming amount of information is there to guide you. While you could certainly get specialized appraisal of art, wine, coins, and most of these investments, and numerous price guides even exist, it is still subjective, and looking at comparables doesn't guarantee a particular price for your specific asset. Likewise, in regard to appreciation, if you hold your investment for a long time, it will probably appreciate, but probably is not a guarantee. It is possible you may spend a large amount of money on these and not see a return. You may also face the issue of liquidity and fraud. Selling collectibles can be challenging because you may not always be able to find a buyer, and also because counterfeiting is common in the collectibles world. It is possible to navigate all this with expert appraisals, but you do have to be careful. Finally, keep in mind when collectibles appreciate in value and are sold, a capital gains tax is assessed on the sale. So after listing all these negatives, why do people invest in these miscellaneous alternative investments? Well, one reason may be because they enjoy a specific collectible. Perhaps they were a coin collector or a wine aficionado their whole life and want to invest in these, even if the returns are not spectacular. Another case could be made for diversification, as these investments don't follow stocks and bonds directly. Here you do have to be careful because in the end, these alternative investments are luxury goods and will rise in value with the overall fortunes of wealthy buyers, which is usually tied to the stock market. As far as income from the sale of these assets, there's certainly a lot of potential there, especially when it comes to art. Due to the unique methods of art valuation, as well as the obvious scarcity of classic original works, and the general trends in the world of art, paintings and other art can appreciate quite a bit and give you very significant returns on investment. It's not unheard of for paintings to appreciate by millions of dollars from their original price. Alright, that was an all-around overview of alternative investments, and hopefully now you have a good idea of what they are and if this is something you want to venture into as an investor. If you enjoyed this video and found it useful, please do consider subscribing to this channel and turn on notifications so you don't miss any of the upcoming investing and finance videos just like this one. Thanks for watching, and I'll see you guys soon.